a company whose stock price rose from around £100 at the start of the year to over £1,000 by the summer.
History has a strange way of repeating itself, especially when money is involved. People rush in, prices skyrocket, and it feels like the future has already arrived. But then, almost overnight, the dream collapses. Fortunes disappear, markets crash. What's fascinating is that these disasters weren't always caused by complicated financial tricks. So today, let's explore some of the most shocking economic bubbles in history and how they changed the world forever. 1. South Sea Bubble, 1711-1720. In the early 18th century, Britain was drowning in national debt after years of expensive wars. To solve this crisis, the government supported the creation of the South Sea Company. The idea sounded brilliant on paper. The company would take over a large portion of Britain's national debt, and in return, it would receive exclusive trading rights with Spanish South America. Investors were told that the region was overflowing with gold, silver, and endless opportunities for profit. That promise alone was enough to ignite a frenzy. Soon, everyone from wealthy merchants to ordinary citizens rushed to buy shares. The stock price of the South Sea Company skyrocketed in a very short time. That dozens of strange companies started appearing, each claiming to offer incredible returns. One of the most famous examples was a company that openly admitted it was created for an undertaking of great advantage, but nobody to know what it is, But behind the scenes, things were far less impressive. The South Sea Company's actual trading opportunities were extremely limited. As insiders quietly began selling their shares to lock in profits, confidence in the market started to crumble. Once investors realized the company's value had been wildly exaggerated, panic spread quickly. The stock price collapsed almost overnight. Thousands of investors were ruined. Fortunes vanished, and the scandal shook Britain's political system. Even members of parliament were implicated in the disaster. Although the company survived in a reduced form, the South Sea Bubble became one of the earliest and most famous examples of a financial bubble fueled by hype, speculation, and blind optimism. 2. Mississippi Bubble in 1717-1720. Around the same time Britain was dealing with the South Sea disaster, France was experiencing its own financial experiment that would end just as dramatically. After the War of the Spanish Succession, France was buried under enormous national debt, and that solution appeared in the form of a Scottish economist named John Law. Law believed he had a revolutionary idea. Instead of relying on gold and silver coins, he proposed introducing paper money backed by the wealth of France's colonial territories in North America, particularly Louisiana. To put this plan into action, he created the Mississippi Company in 1717, granting it exclusive trading rights in the massive Louisiana territory along the Mississippi River. The opportunity sounded incredible. Stories began spreading that Louisiana was filled with diamonds, gold, and endless natural resources waiting to be exploited. Investors across France became obsessed with the company's shares. The price of Mississippi Company stock surged as people rushed to invest in what they believed would become one of the richest enterprises in the world. But the truth was far less glamorous. Louisiana was largely undeveloped, and the promised wealth simply didn't exist. The company struggled to generate real profits, and investors slowly began losing confidence. As doubts grew, many people rushed to exchange their paper money for gold and silver. This triggered a massive financial panic. The value of the shares collapsed, and the paper currency that supported the system rapidly lost its worth. John Law's entire financial experiment imploded. Facing public outrage, he fled France in disguise, leaving behind a devastated economy and countless investors who had lost everything. 3. Railway Mania, 1840s. By the mid-19th century, the Industrial Revolution was transforming Britain. Factories were booming, cities were expanding, and one new technology seemed poised to change everything: the railway. Trains promised faster transportation, stronger trade connections, and economic growth on an unprecedented scale. Naturally, investors saw a golden opportunity. Thousands of companies were created, each claiming they would build profitable railway lines connecting cities across Britain. Investors poured enormous amounts of money into these ventures, believing they were investing in the transportation network of the future. At first, the excitement seemed justified. Several early railway companies delivered strong profits, which only encouraged more speculation. Soon, however, the mania spiraled out of control. Companies began proposing unrealistic routes, exaggerated profit projections, and in many cases, projects that had little chance of ever being completed. One of the most famous figures during this period was George Hudson, often called the Railway King. Hudson became incredibly wealthy and influential by promoting railway investments. But his empire was built on questionable financial practices. Investigations later revealed that he had manipulated accounts and engaged in fraudulent deals to maintain investor confidence. Eventually, reality caught up with the speculation. In 1847, rising interest rates and tightening credit exposed how unstable many railway companies truly were. Projects ran out of funding, fraudulent schemes collapsed, and share prices plummeted. Investors who had believed they were backing the future of transportation suddenly found themselves facing massive financial losses. Railway mania became a classic example of how technological excitement can quickly turn into dangerous financial speculation. 4. The Great Depression, 1929. During the 1920s, the United States experienced what many called the Roaring Twenties. It was a time filled with optimism, economic growth, and the belief that prosperity would last forever. Businesses expanded rapidly, new technologies appeared everywhere, and the stock market became the place where ordinary people believed they could get rich quickly. Millions of Americans began investing in stocks, many of them for the very first time. But there was one dangerous twist. People were often buying stocks on margin, meaning they were borrowing money to invest. As long as prices kept rising, this strategy seemed brilliant. Investors believed the market would continue climbing indefinitely. By late 1929, however, the situation had become extremely fragile. Stock prices had risen far beyond the real value of the companies they represented. When doubts started creeping in, panic spread through the market. Then came Black Tuesday, October 29, 1929. Investors rushed to sell their stocks, but there were far more sellers than buyers. Prices collapsed dramatically, wiping out enormous amounts of wealth in just a few days. But the real disaster came afterward. Banks had heavily invested in the stock market, and when it crashed, many financial institutions failed. Thousands of banks closed their doors, and millions of people lost their life savings. Unemployment soared to nearly 25% in the United States, and families struggled to survive. Bread lines and soup kitchens became common sights, the worst economic crisis of the 20th century. 5. Japanese asset price bubble, 1980s-1990s. In the late 1980s, Japan was seen as an unstoppable economic powerhouse. Its technology companies, manufacturing industries, and export businesses dominated global markets. Many believed Japan's economy was destined to become the largest in the world. After the Plaza Accord in 1985, the Japanese government introduced policies that made borrowing money extremely cheap. Banks began lending aggressively, and suddenly huge amounts of money flooded the economy. Investors started pouring this easy credit into stocks and real estate, pushing prices higher and higher. The real estate market became particularly outrageous. Land prices in Tokyo reached unbelievable levels. At one point, rumors circulated that the land beneath the Imperial Palace was worth more than all the real estate in California. The stock market followed the same explosive path. The Nikkei 225 index climbed rapidly and reached nearly 39,000 points in December 1989, the highest level in its history. But the rapid growth was built largely on speculation and borrowed money. Concerned about the overheating economy, the Bank of Japan raised interest rates in 1990. That single move triggered a massive collapse. Property values and stock prices fell dramatically. Banks were left with enormous unpaid loans, and companies struggled under heavy debt. The collapse didn't just cause a short recession, it led to what economists call Japan's lost decades. For years afterward, the country experienced slow growth, deflation, and job insecurity. What once looked like the strongest economy in the world suddenly faced a long period of stagnation. Dot-com bubble, 1995-2000. When the internet began spreading across the world in the 1990s, it felt like the beginning of a revolutionary new era. The technology promised to transform how people communicated, worked, shopped, and lived. Investors quickly became convinced that the internet would unlock endless business opportunities and create a completely new digital economy. Soon, companies with .com in their names started appearing everywhere. Many of these startups had exciting ideas, but very few had solid business models or real profits. Despite this, investors poured billions of dollars into internet ventures, hoping to back the next big technology giant. Stock markets became heavily focused on tech companies. The Nasdaq index, which included many internet firms, began climbing rapidly as venture capitalists and investors. The excitement reached its peak on March 10, 2000, when the Nasdaq hit record levels. But behind the hype, many companies were burning through cash without sustainable revenue. Eventually, investors realized that many of these businesses were overvalued. Confidence collapsed, stock prices plunged, and hundreds of internet companies went bankrupt, wiping out trillions in market value. 7. Asian financial crisis, 1997. During the early and mid-1990s, several Southeast Asian countries were being praised as economic miracles. Nations like Thailand, Indonesia, and South Korea were often called the Asian tiger economies. Their industries were expanding rapidly. Foreign investors were pouring money into their markets. Because of this confidence, huge amounts of foreign capital flowed into these countries. Investors were attracted by high interest rates and booming real estate markets. Banks and businesses borrowed heavily from international lenders, often taking short-term loans in foreign currencies. For a while, everything looked stable and profitable, but beneath the surface, the system was far more fragile than it appeared. Financial regulations were weak, banks were overlending, and many companies were carrying dangerous levels of debt. When economic growth began slowing, the cracks started to show. The crisis officially erupted on July 2, 1997, when Thailand ran out of foreign reserves needed to support its currency, the Thai baht, and was forced to devalue it. This single event triggered panic across global markets. Investors rushed to pull their money out of Asia. Currencies collapsed, companies went bankrupt, and millions of jobs disappeared. The crisis quickly spread to Indonesia, South Korea, and other countries in the region. For millions of ordinary people across Asia, the financial collapse meant unemployment, poverty, and years of economic hardship. 8. Irish property bubble, 2000-2008. In the early 2000s, Ireland experienced a period of extraordinary economic growth, often referred to as the Celtic Tiger. With strong foreign investment, a booming job market, and rising incomes, the country seemed to be entering a golden age of prosperity. One sector that exploded during this time was real estate. Property prices across Ireland began rising rapidly, and many people became convinced that housing prices would never fall. Buying property was seen not just as a necessity, but as the safest and smartest investment anyone could make. Banks played a major role in fueling the boom. They offered extremely generous loans, sometimes even 100% mortgages, allowing buyers to purchase homes without any upfront payment. Lending rules became increasingly relaxed, and people were encouraged to take on large debts to buy houses or invest in property developments. Construction companies rushed to build new homes, apartments, and commercial buildings across the country. For several years, the housing market continued climbing, reinforcing the belief that prices would only keep rising. But when the global financial crisis of 2008 hit, everything changed. Property values collapsed dramatically, in many cases falling by more than 50%. Thousands of homeowners suddenly found themselves in negative equity, meaning their homes were worth far less than their mortgages. Ireland's banking system was pushed to the brink of collapse, forcing the government to step in with massive bailouts. The property boom that once symbolized Ireland's success became one of the most painful economic crashes in its history. 9. United States housing bubble, 2000-2008. In the early 2000s, the United States experienced one of the most dangerous housing booms in modern history. Low interest rates and relaxed financial regulations made borrowing money incredibly easy. Banks and lenders actively pushed people toward homeownership, presenting real estate as a safe and guaranteed way to build wealth. Even individuals with weak credit histories were approved for subprime mortgages. These were high-risk loans given to borrowers who often had little ability to repay them. Many families ended up buying homes far beyond what they could realistically afford, believing that rising property prices would eventually solve everything. Meanwhile, large financial institutions began bundling thousands of these risky mortgages into complicated investment products known as mortgage-backed securities. These products were sold to investors around the world and were frequently rated as safe investments. For several years, the system appeared to work. Home prices kept rising, construction surged, and confidence remained high. But around 2006, the housing market started to slow. As prices fell, millions of homeowners struggled to keep up with mortgage payments. Defaults and foreclosures quickly increased, triggering a chain reaction throughout the financial system. The crisis exploded in September 2008 when investment giant Lehman Brothers collapsed, sending shockwaves through global markets and plunging the world into the Great Recession. 10. Cryptocurrency bubble, 2020-2022. During the pandemic years, cryptocurrencies moved from a niche technology to a global financial sensation. Millions of new investors entered the market, drawn by the promise of decentralized finance and stories of people turning small investments into massive fortunes. Bitcoin, Ethereum, and thousands of alternative coins surged in value as excitement spread across social media, online communities, and even mainstream finance. By late 2021, the total value of the global cryptocurrency market had climbed to nearly $3 trillion. For many investors, it felt like a new financial revolution was underway. But much of the growth was fueled by speculation rather than real-world utility. When central banks began tightening monetary policies in 2022 to fight inflation, the flow of easy money slowed down. Confidence quickly started to fade. Several major crypto projects collapsed, including the Terra Luna ecosystem, which lost almost all its value. The final shock came with the collapse of the massive crypto exchange FTX, revealed to be a huge fraud, wiping out billions and shaking trust across the entire crypto industry. History shows us one powerful lesson. When everyone believes that prices can only go up, that's usually when the biggest crashes are just around the corner. From ancient trading companies to modern housing markets and digital currencies, financial bubbles have appeared again and again. Each one started with excitement, optimism, and the promise of easy wealth, but many ended with devastating consequences for ordinary people. Now we're curious to hear from you. Which of these economic bubbles shocked you the most? Drop your thoughts in the comments below. And if you enjoyed uncovering these fascinating moments from financial history, share it with someone who loves learning about history. Don't forget to like the video and subscribe for more eye-opening stories just like this.